I want to do a quick introduction to what we are, who we are, and what we're doing, and then we'll hop right into the good content. So we are Equi. We are a one-stop shop to get a diversified basket of alternative assets. So you can think about this almost like having your own family office and investments that would usually be available for only the ultra high net worth individuals, now being accessed by a much bigger, broader audience. So what we do is we help investors get access to a basket of 15 to 20 different underlying private funds. We've done all the heavy lifting, or shall I say Itay and his team has done all the heavy lifting to make sure that they're best in class. Best of all, it's powered by tech. So all in one place, as close to 1K1 as possible, so that this is something that could be much easier accessed. And I'd love to introduce everybody here to my co-founder and our CIO, Itay Vinik. Itay came from UBS Ultra High Net Worth, where he saw how billionaires invest and beat the system. Started his own boutique RIA with over 100 million. He's ran a hedge fund with almost zero correlation to the markets. He's our CIO of one of the fastest growing invest tech platforms around. Itay, what are you doing in London? Tell us a little bit more about what's going on there.
Yeah, it's been a great week. Just very busy, back-to-back meetings with potential investors that are looking to enter Equi. What's interesting is that Equi was formed as a platform to democratize this type of elite investing. But what's interesting is our offering has been so compelling and performance has been relatively very good that some of the family offices themselves are looking at Equi as an option to invest, even though they can do the heavy lifting themselves. So I think that's a really interesting thing. And that's the main reason I'm in England today.
Well, thank you so much for sharing that. I know you've prepared a whole schedule of really interesting content to talk about today. Could you tell us what we're going to cover and then maybe get us started so we can dig in onto it together?
Yeah, it's going to be an interesting time as it relates to England. We have some depegging event that took place here maybe about 30 years ago. Other than that, we're going to cover recently what happened with Terra Luna and some market updates of what's going on in markets today and what investors want to know. So without further ado, I'm more than happy to get started. As Jeremy mentioned, we are Equi, making elite investing accessible. And I'm going to hop right into it. Today is June 8, 2022. And our recent market update. What everybody wants to know is whether or not we're in one of these so-called bear market rallies. The market peaked on the first day of 2022, just over 4,800 on the S&P, fell to 4,200, rebounded about 9%, and then faltered again, and then had another 11% very quick, fierce move up that fell apart as well. And now we've been in one of these current 9% rallies. So if you think about the 2000 to 2002 bear market, for example, you had about 11 or 12 of these bear market rallies averaging something similar to this. And the mechanic is interesting. You know, the market gets overly short, overly hedged. Then you get an unwinding of these short positions in these fierce bear market rallies. And then eventually they fall apart because they come from predominantly short covering versus actual sustainable buying. So that really is the difference between a bear market rally and more of a sustainable bull run. So again, the question is this just another bear market rally and it's just going to fall apart like the other two? And then are we in a more prolonged bear market? We'll try to answer that question today.
Great.
Okay. Let's talk about the dollar yen. And as it relates to this, there is a little bit of a currency theme to today's call, and we're going to talk about some currency pegs as well. So let's start with the yen. The yen is one of the most important currency trades there is, currency pairs, I would say, or really the dollar yen, where it has a lot of relations to US yields. Because it's used as a funding currency. So what's a funding currency? If rates are very low in Japan, people can borrow yens and use that in order to buy dollars. And then they use those dollars to buy treasuries. So if the expectation is for interest rates to rise in the United States and stay the same or lower in Japan, it makes a lot of sense to do so. And then as the yen moves upwards, the yen moves, I would say, weakens, it can put pressure on US Treasuries, as we've seen in the past, a very strong correlation. So it's important to notice what the yen is doing in order to get a clue of where US rates are going. And what we've seen indeed is this really tight correlation between the yield on the 10-year treasury and the US dollar JPY currency peg. So again, if this line moves higher, or I would say the orange line, that means the yen is weaker versus the US dollar.
What's the lag between these two in terms of time?
This is a one-to-one. Just I'm gonna pause notifications here. There's no lag. This is immediate. So what we've seen in the last few days is that the yen broke to new lows versus the US dollar, which implies we may see new highs on the 10-year treasury shortly, which may, again, the theme was higher interest rates put pressure on the equity markets, and that may be the case here again.
What happens to the default risk of Japan if this ends up becoming if the yen depreciates further and continues to spike up in terms of how many yen you're getting per dollar?
Yeah, that's a great question. So Japan actually implements what's called yield curve control because it's a heavily indebted country. They have the highest ratio of debt to GDP in the developed world. I believe it's over 300% to GDP. So what they do is they limit the 10-year treasury at 0.25% and prevent it from going higher. Again, talking about pegs, this is, like, I believe, the world's biggest one. Now, the problem with that is that as US rates go higher, there's a natural market need for those rates to go higher as well in Japan, but Japan prevents them from going up artificially. And the way they do that is they print yen in order to buy their 10-year treasury and keep the peg at 0.25%. As long as that's happening, that's really the reason behind this yen depreciation. So in a way, Japan can't technically default because they are printing as much money as they need to avoid it. However, that can crash their currency. So, at some point, they're going to have to make a decision whether or not their currency continues to depreciate, or they will have to abandon their yield curve control. And then you have a real risk of default. So I think they're in a very, very difficult situation.
Got it. Thank you.
Yeah, absolutely. So there's no surprise that we've seen this really tight correlation between the yen trading and the MOVE index. So the MOVE is the quote VIX for the bond market. And the VIX for the bond market has moved lower. I think that's not going to be sustainable if the yen is going to continue to depreciate in this violent kind of manner. It's also been somewhat correlated with the S&P 500 because the S&P 500 has been following rates, right? Higher rates and rates moving violently have been negative for equities throughout the whole year. That's been the theme. And now we're seeing the dollar yen breaking to new lows in the yen. I think it's going to eventually lead the S&P lower.
What are the mechanics of why that would move the S&P? Why further depreciation would move the S&P lower?
Yeah, I think predominantly because of the impact it has on higher rates, higher interest rates. So we've seen the whole year, the theme was that higher interest rates led to lower equity prices as the Fed is moving really fast to subdue inflation. Higher borrowing costs have not been good for corporate earnings. They slow down the market. They can slow down anything from retail sales to housing and mortgages, right? So I think that's why it relates overall to lower equity prices. You've also seen this correlation between the VIX on the yen, right? The implied volatility of the yen and the VIX itself. So over the last couple of weeks, we've seen a pretty big decoupling there. I think it's going to reconnect, most likely. Another thing that's really interesting that's going on right now is quantitative tightening is starting. It's starting very, very soon. The first day of quantitative tightening is actually June 15th. We had to figure out how to back into what the Fed is holding when it's maturing and what the impact is going to be. So these are days to watch for. On the 15th of June, roughly 15 billion. And then these are both treasuries and mortgage-backed securities. Now, these numbers are expected to go up to almost 100 billion by September. And this is the first time we're engaging in QT in this entire period. So thus far, it's only been expectation of QT. It's been interest rates increases, but QT is really starting now.
And so for everybody who doesn't know QT, let's just touch on it really quick. So the Fed prints money, and what happens is they basically trade those to the federal government in exchange for bonds. And so they are now owed, the Fed is now owned basically their debt, their principal payments back to the tune of $50 billion more or less for this month. So QT basically telling us, hey, money that was going to go originally to the Fed, they're now going to delete out of circulation entirely. So we're actually quantitative tightening where we're shortening and making smaller the total money supply for the first time in a while, right?
That's exactly right. I mean, the Fed did have a period where they tried to do QT in 2018. The S&P 500 dropped about 20% into December of 2018, and then the Fed pivoted. But again, inflation was less than 2%. It was not very difficult for the Fed to pivot during that time. That was actually that period where the balance sheet of the Fed contracted in 2018. And it did lead to a period where, so in this case, you're seeing the market cap of the FANGs, right? The Apple, Amazon, Facebook, Google, Microsoft, Netflix, and Tesla. And they've shown a very strong correlation with the Fed balance sheet. And they didn't really do much during the period from 18 to 2020 when the Fed didn't increase their balance sheet. And look at that post-COVID response when the Fed increased their balance sheet substantially. The market cap of all those FANGs really, really exploded. And now it seems to be responding to the forecasted balance sheet following QT.
Itay, is there any evidence that the market has already taken into account this QT already happening for why we've seen this bigger drop recently?
I believe so. I mean, I think that this latest correction in the FANG market cap that started in January, really is lining up with where the balance sheet is expected to go. You may even make the argument that it's overcorrected to the downside given the immediate level of QT, but given where we're expected to go within the next year or so, it's difficult to think of where the drivers are going to come from. Where's the liquidity going to come from to take the market caps to new high, unless the Fed pivots away from what they're forecasting to do. Which, by the way, they've done that in the past. So in 2018, the Fed expected to do a much more meaningful QT, and they completely backtracked. So right now, the QT that we're expecting is far more aggressive than anything they did in 2018.
Cool, thank you.
So it's interesting. Liquidity is already very, very low. So what you're seeing here is what we call top of book size. It just means that what is the depth of the market at a certain price level in the S&P 500. So if you want to move a big book, if you want to sell, if you want to buy, if you're JP Morgan, how quickly could you get it done? And what dollar amount is enough to move the market? So at every single point or every quote of the S&P 500, you're only showing about $2.5 million worth of liquidity. Compare that to, let's say, summer of 2021, when that number was $30 million. So lastly, we've seen these levels of low liquidity in 2018. That is exactly when that QT took place, the first one. And then it ended in December. And then during the crash of 2020, during COVID. Other than that, we haven't seen such low levels of liquidity.
So the implications of this are basically, let's say we're under the 200-day moving average, and it looks like there's a pattern of drawdowns, and now all of a sudden there's low liquidity, and then there's more selling that's happening. Does that mean that it's easier for the market to move downward faster because there's less liquidity at each different level?
Yes, that is exactly right. But there's one caveat to that. It's also easier for the market to move higher with less buying. So that's why you're seeing these bear market rallies that are really sharp, like 9-10%, and then they fall apart, exactly for this reason. Because if a big fund decides to buy back their short positions, it doesn't take too much buying to make a large move. So low liquidity just amplifies volatility, and it cuts in both directions.
So Itay, why does low liquidity even happen anyways? Is this just people saying, I'm scared, I kind of want to just figure out what's going on before I act?
That's correct. Like big institutions, market players are sitting on their hands. There's no real conviction. The macro environment is not clear. There's uncertainty. They don't know what they're doing, but also the Fed has a lot to play with this, right? So during periods of QE and low interest rates, there's just more liquidity in the system. It's how it goes. But during periods of rate increases, quantitative tightening, liquidity is lower. And what's interesting is that this period here, when the Fed did QT and then it pivoted right there, we're actually starting at the pivot point of 2018, and QT hasn't even started yet. So I'll be really curious to see how the liquidity situation looks like a month or two in QT to see if it actually deteriorates or not.
Okay, that makes sense.
So at the same time, the market's been boring, right? In the last 2 weeks, it's done nothing. We had that big short squeeze from 3,800, and we haven't really moved for the past couple of weeks. So why is that? Why are we not moving? You can even see that despite the S&P moving lower, volatility is measured by first month VIX futures really was subdued. We've not seen a lot of volatility at all. There's been a lot, or the VIX has not made a new high. There's been a lot of talk amongst traders, portfolio managers, people that I talk with, and really the go-to question is why isn't the VIX higher? Realized volatility is really high. Why isn't the VIX substantially higher? And I think a lot has to do with a very large hedge position that's already in. So a lot of funds, a lot of market players have already bought puts. And as the market moves lower, there's less of a reason for them to really buy additional options, which makes the VIX a little bit subdued. Now, next week, there's a really big event that's taking place on June 17th, and that is one of the largest options expirations in quite some time. It's a quarterly expiration, so there's futures involved as well, not just options, single stocks, indexes. And it's $3.2 trillion of notional value that is set to expire. So it's an insane amount. There are many puts that people own at the 4,000 strike and all around where the market's trading now, which explains a lot of that stickiness. Why is the market stuck in a range? Because there's just so many options in both directions. And as the market moves lower, they can act as support for prices from falling too much, or as the market moves higher, it resists the prices, as that open interest is where prices tend to trade. However, what I will say is that it also brings the risks quite a bit, because if there's a lot of puts at 4,000 and the market falls below 4,000, market makers will have to hedge that by selling short S&P futures to offset that position, and that could cost selling into selling if the market falls below certain levels. If the market goes above certain levels, it can actually trigger a move up in the same type of reaction, but the downside is likely more severe than the upside given the positioning of options.
Let's try to backtrack and make sure we kind of understand it there. So what I'm hearing you basically say is, hey, there's a lot of selling pressure within a specific window. Specifically, one of those windows to look at is 4,000. And so you're basically saying, if come toward expiration, the market is trading around 4,000, that could trigger a lot of forced selling that happens, which would then push the market in the immediate down faster. Is that correct?
Right, but it needs to break 4,000 to do so. Now, it's also quite likely that the market will be frozen between now and option expiration, roughly between 4,000 and 4,200. And then after that option expirations happens, it would, quote, be free to move, because a lot of that option pressure will actually go away at expiration. However, with that caveat said, so again, yes, the markers to look for is 4,200 for an upside trigger and 4,000 for a downside trigger. And what's really interesting, though, is that we do have a lot of potentially market moving events between now and then. So on the 10th, which is Friday, we get the CPI data. I think it's incredibly important because a lot of market participants tend to believe that inflation has peaked already. So what everybody's looking to see is whether or not we get a lower number from last month. If we get a lower number from last month, that means that the Fed may have, what the Fed is doing may finally be working, and they're actually working in the right direction, and maybe they won't have to raise rates as much, or maybe they won't have to QT as much as they're doing. But if inflation still comes in hotter than expected and has not peaked, I think that's potentially a really negative event for the market.
Does it matter how much lower CPI would come in at? I know we were at 8.3 last month. If we come in at 8.2, is it just the fact that it's lower, or does it have to be a certain margin lower than the previous announcement?
I think that anything that is within expectation. I believe the market expectation is for 8.1%. So if you coming in 8.1 or lower, that will probably be seen as positive. But if you imagine coming in at 8.5 again, or even 8.6, I can imagine that being a pretty disastrous print, because the Fed will just have to be even more aggressive.
And when we say more aggressive, that means on either QT or on raising interest rates, all of which we've seen cause some downward movements in the S&P 500.
Yeah, or both at the same time. Another thing that's happening on the 15th, you get retail sales now. I think that's a pretty important thing as well, given that we're seeing consumer weakness recently. I mean, if you've seen the earnings of Target or Walmart recently, this quote stagflation environment starting to really impact the consumer. We'll cover that in a second. So if we get a mix of higher inflation and weaker retail sales, that's just another indication we're likely on the way. We're in a prolonged bear market, and we're just going to get more of the same. Now, on the 15th of June, we have the FOMC decision. The Fed is expected to raise interest rates by 0.5%. So again, we're getting a two hikes into one again, back to back. And in July, we're probably going to get another 50 basis point hike again. So the Fed is, so far, everybody's expecting this. But what makes this cocktail very risky is that we get this $3.2 trillion expiration literally 2 days after the FOMC. So again, talking about that inflation number, you can see where we landed. You're right, at 8.3, market's expecting 8.1. Again, big question, what's happening? I saw oil today trading above 122, natural gas at $9.50. I'm not feeling too optimistic about a low inflation print.
Got it. And that's because 23% of inflation is related to energy, right?
You can see that right there. So that's the breakdown. Services was 2.9% of CPI, and energy was 2.1. So again, we got a little bit of a lower print last time on energy, but I think that's going to go away with energy back higher. Okay, so let's talk about the consumer. We brought that up a little bit. Credit card debt is reaching all-time highs. We've had last month the highest print of new consumer credit, and now we're getting the second highest print. This is not good. Credit card debt is the worst type of debt, and that tells you that saving rates are lower. The consumer is getting over-levered, and potentially, if we do go into a recession, having 70% of the US economy and earnings for corporations based on consumer spending, that's not a very bullish sign, for 6 to 8 months down the road. Yeah, as I said, second print ever for revolving credit. So, and interest rates on credit cards are increasing as well, at the same time. It's a very bad type of debt to have. And revolving credit now just hit an all-time high. So all that deleveraging, lack of spending people did in COVID because everything was closed is now back up. Inflation has made up for that with things becoming a lot more expensive. And at the same time, the saving rates that really peaked during COVID, there was a lot of savings that happened when everything was closed. People weren't buying anything. They were getting government assistance. The government assistance has dried up, and the saving rate is back to 2009 levels at the same time when credit card spending is at an all-time high. Not a good mix.
Mm-hmm.
Okay, so I think this was pretty much our market update portion, and one of my favorite topics is currency pegs.
All right, let's talk about currency pegs. Let's do it.
For some of the unstable pegs. So
do you want to first even talk about what is a peg?
Right. So a peg is an artificial fix that one thing is worth something else, right? So let's say we decide that, like prior to or Bretton Woods, where 1 ounce of gold is worth $20, right? And you can always exchange that dollar for the $20 for 1 ounce of gold, and it's just fixed at that price until something breaks, clearly, because it is artificial. It's not subjected to the market. It's arbitrarily fixed there by some kind of entity.
Yeah. And why does somebody choose to do that?
Various reasons. There could be all types of reasons to do so. Like recently with Terra and Luna, it was fixed to the US dollar in a way to make it seem stable. So an easy way to make 20% yield on dollars just sitting in cash, which is a very promising value proposition that ended up not working so well. But there are various reasons to do so. Like, for example, Britain fixed their currency to the Deutschmark because of the way the mechanism worked at that time, which we'll explain. So roughly 30 years ago, here in England, we had an event called Black Wednesday, which saw the British pound sterling completely collapsing, which what appeared to be out of thin air, but it really wasn't. In a very spectacular event in which a very famous George Soros walked away making over $1 billion from. And we'll cover how that actually happened.
I am excited for that. Let's do it.
Okay, so the quick background is that there was something called the ERM, the exchange rate mechanism, that predated the euro. And what happened was that all the different countries that were in there, including the United Kingdom and Germany and France and Italy and Spain and Portugal, decided that they're fixing their currencies to one another, and they allowed them to fluctuate by 2.25% from one another. So every time that it fell to the lower bound of that currency peg or currency fix, what the country needed to do was basically to buy more of their currency using foreign reserves in order to keep it within that currency peg, within that stability. And what's interesting is that the most stable in Europe, the most stable currency in Europe was the Deutschmark or the German mark. So net, after really everything was just fixed with the Deutschmark. The German mark was effectively similar to what the US dollar was for a global reserve currency, but then the German mark was that type of currency for Europe. And there is an unofficial built-in lending mechanism that was built into the ERM in order to prevent those type of pegs from collapsing. And it was the Bundesbank, which is the German central bank, that was supposed to technically fund it and give aid to countries suffering from currency crises. So how does this all unfold? So as I mentioned, again, the German mark the position is effectively the reserve currency of the ERM, or the European Exchange Mechanism. And you can think of it as what the US was after Bretton Woods, which just established it, and then it was established the dollar as the global reserve currency, and then the dollar was backed in gold. But the difference is here, the German mark wasn't really backed by anything. So in actually the 80s, Germany had very low inflation. They always wanted low inflation. And a lot of the European countries, when they wanted to integrate into the ERM, they were actually pretty successful in lowering their inflation rates to come close to that of Germany, which made this possible to enter the ERM. So you can see here, even countries like Italy that persistently had very high inflation in 1980, over 20%, were able to take it down to close to 5%, and all the currencies converged, which made it seem very possible that the ERM could really work. So then how did the crisis happen? It really all started with the reunification of Germany. And then that caused some divergence in the economy, and I'll cover that in a second. So what about the reunification of Germany? Think about prior to 1990 and the reunification. You really had a very Western economy in West Germany that was incredibly advanced, sophisticated, trade heavy, very capitalistic. And then you have East Germany that came under many years of Soviet control. And it was completely poor, had no capitalist system, and no infrastructure. But it was the same country. So imagine today, what if North Korea decided to become democratic and reunite with South Korea? That's literally kind of the same thing.
Be an interesting thing to see.
Right, but what kind of economic burden would that put on South Korea if that was the case? Right, that all of a sudden they need to build infrastructure, they need to support the North. I mean, you can't even compare the GDP per capita of the two different countries now, but it is the same country. So it put a lot of strain on the German economy. A lot of the saving of West Germany went to East Germany. And what happened is that German inflation and German deficit really increased. And Germany has this history where they really dislike inflation because of what happened to them during the Weimar Republic in the 1920s. It's kind of this large collective.
That's the whole wheelbarrows of money to get a loaf of bread type of situation.
Correct. And then
they're all sensitive to it.
And then it led to the rise of Nazism and all the dark history that came out of it. So they're very sensitive to the idea of inflation, and they tend to fight it quite a bit. And what happened is that the Germans realized that they have high inflation. So immediately they raised interest rates by 3% in 1991. They went very aggressive. And then they didn't want to give money to all the other countries to support the ERM mechanism because they were worried about their own inflation. So the higher the interest rates started going in Germany, the more of a problem the rest of Europe was having, because they had to spend all their foreign reserves to support the peg, because money was going from their countries to higher yielding opportunities in Germany, and the entire rest of the Eurozone fell into a recession.
So let's talk about it from the perspective if I'm sitting in the UK. So all of a sudden we see, I'm one of these bankers sitting in London, and I see the German interest rates rising. Does that mean that now I reallocate my capital and purchase some of those government debt instruments now?
Yeah, I mean, imagine you have higher yielding bonds in Germany, and you're expecting the mark to stay the same because you have the ERM mechanism. So effectively, you have no currency risk. So you're going to take your pounds, you're going to convert it to marks, and you're going to buy German bonds instead of British bonds. So money will flow into Germany naturally.
Got it. So this causes then money flows in. And why does it put the peg at risk?
Because at some point, there's an economic pressure for the pound to devalue if it's in a recession. They need lower pounds, they need lower interest rates to stimulate the economy, make their exports more competitive with world markets, but artificially they can't do it. So the money is just getting pulled out and going to higher yielding opportunities elsewhere. And with lower economic activity in those countries, there's less investment opportunities as well.
Got it. All right. Keep telling us more.
So again, this is a little bit of an idea of what the reunification did. The German money supply increased, which obviously caused that inflation that caused Germany to raise interest rates. And the fiscal deficit went from 5 to 13%. Now that seemed an absurdly low number, but back then there was still a lot of fiscal conservativeness in the world. Compare, for example, to what COVID did, which triple-digit type deficits. But I'm not gonna mention that. Simple times, indeed. So what happened then is this very aggressive, hawkish contraction monetary policy in Germany, raising the interest rates, and consistent worried about inflation causing more appreciation of the mark. The higher interest rate goes, the more compelling the mark is, the more people think that the Bundesbank is going to be more restrictive, the higher the mark goes. Not very dissimilar from what's happening in the US dollar now. The US dollar is at about a 20, 30-year high because the Fed is being so aggressive, raising interest rates. Global money is moving to the dollar. I mean, I'm here in the UK, and it's basically the pound, I believe, is 1.24, 1.25.
Crazy.
London has never felt this cheap.
I remember when I was living in the UK in 2007, I had a 2.1 US dollar to pound conversion. So it really kind of
Right.
shows.
Right. Now you're going for a cup of coffee and it's £2, and that used to be $4, but now it's basically just $2.2, right? It's cheaper than the US. But the people living here don't feel it because they're still earning the same and living in pounds. So that's kind of how that works. So what this creates for the UK, they fell into the worst recession since World War II. They had really high unemployment, and what they need to do is lower rates. There was no QE at the time, but even that, something like QE, lower rates, depreciate the currency, stimulate the exports and all those kind of things, but they can't do it because they're fixed to Germany. And as a result, they're basically tightening into a recession, kind of like what the Fed is doing.
They're tightening because money's leaving the UK and going so there's literally less currency around.
Right, and it's just making things worse for the UK.
And they're eating through their FX reserves to try to keep up this peg. So now they're at risk.
That is exactly how that unfolded. So the higher rates in Germany, money flows out of the United Kingdom, money goes in, getting lost. And there's more and more pressure every day that goes by to leave the exchange rate mechanism and devalue the pound. So then the speculators come in and they realize that there's only a 2%, 2.25% rate in which the pound can appreciate, hypothetically. The market pressure is for the pound to devalue and leave the exchange rate mechanism. And it's effectively a riskless, almost like riskless trade, because if you sell pounds to buy marks, there's no downside. So it's very famous that Stanley Druckenmiller pitched that idea to George Soros in 1991, and he tells him, well, we can just sell these pounds. I don't see how this can go up. I don't see how this can go wrong. I think this is the craziest arbitrage I've seen in my life. And then Soros asked him, well, how much position size of the fund do you want to put in this? And he tells him, I was thinking 5%. And then Soros looks at him and says, no, you're wrong. We should put everything. He says, once in a lifetime, you reach this type of event where there's no downside and only upside. That's when you got to go for the jugular. That's when you do it big. And that's what Soros did.
So let's go back. Why is it a riskless trade? Just walk me through it a little bit slower.
Yeah, so it's really this idea that if you are in an exchange peg, that it's only allowed to fluctuate by 2%, 2.25%. That's really your downside risk. But
so as it goes, about biggest loss opportunity, 2.25%.
Correct. And then if the peg is abandoned, the pound just collapses and you don't know how low it's going to go. And you know that the market wants the depegging because England is in recession. They're losing their reserves. So it's very famously, Soros goes around all the Wall Street banks and realizes he can borrow something like 35 or 40 billion pounds to short, where he realized that the Bank of England had less reserves than what Soros was able to sell. And he realized that him on his own, he can probably drain the Bank of England out of reserves and force them to be pegged. And that's effectively what he went and did.
So let's just cover those mechanics again. So a central bank has FX reserves, which they can use to try to keep up a peg. That can only work so long as there's FX reserves, so long as they're sitting on money that they can use to keep up that peg. Now, all of a sudden, if somebody comes in with more, they can basically drain them out, and then there's no FX reserves left.
Right. They do have one weapon left without reserves, which is the interest rates. So what they try to do is they raise interest rates from 10 to 12% on the same day, which Soros realized that they were getting very, very desperate. Because imagine if you own pounds in a bank and you're making 12% interest now in a year, you want to own pounds, right? Because then you get a higher interest rates. But it just messes up their economy even more because it makes their economy even more restrictive.
It's just more QTing. It's more QTing, and when they need money to flow.
Right. So Soros thought it as a hint of like, whoa, that means they're getting really desperate. They're completely running out of money. I should sell more. So then on the same day, they raise interest rates from 10 to 12, and then they raise it again to 15. And then they ran out of money, and then they depegged on September 16, 1992, in the day called known as Black Wednesday.
Wow. So what's the implications of this then?
So here's exactly the effects. 27 billion pounds of reserves were spent in order to try to defend the pound. And again, this is not 2022 money, this is 1992 money. So it was quite a bit of money to really went down the drain trying to protect this currency peg. And it's really the market knew, when it's the market, Soros and speculators, right? Market knew that they can't keep interest rates high for long because they're in such a bad recession. And Soros walked away making over $1 billion in a single day from that trade, and that's again in 1992. So I think he was a happy man, making one of the most successful trades ever made and bringing down a sovereign nation, a Western sovereign nation, to its knees.
I would say not the most flattering picture, but he definitely looks happy there.
What's interesting though is that the consequences of Black Wednesday were positive all around, because the EU eventually widened the ban to 15%, which eventually allowed the euro to get established. And they signed a treaty to create a stronger monetary union that lead to the euro. One of the things people don't know too is that the weaker currency enabled England to get out of a recession, recover very quickly, recover their exports. And Soros took his profits from the pound short, and he bought British stocks knowing that that's going to happen because now Britain can recover. They don't have this artificial peg anymore. The British stock market exploded, and he made a fortune the following year on the British stock recovery. So people don't know the second side of it.
Which brings a great point, which is why did they try to keep up this peg in the first place?
Sometimes governments do irrational things from, an agreement that was already made, a system that was in place. And it becomes unstable because it was inherently unstable. And we're talking about inherently unstable systems. We can talk about what happened last month, which I actually think it's not that dissimilar from the 1992 British pound incident.
Great. Teach us about it. I'm very excited.
So last month, we've seen the Terra USD, known as USD. I don't like calling it USD because I think about US Treasuries. So I call it Terra. Terra was the stable coin of this ecosystem that has the native token Luna, and it's supported by this money market reserve that caused this fake demand for Terra. Really, this anchor protocol that gives you 20% yield on Terra, and that creates all this demand. So Terra is supposed to be the stable coin backed by Luna, and then all the demand comes from Anchor, really. So what is Terra? Terra is a stable coin. What is a stable coin, right? A stable coin is a coin that's it's a crypto, so you can use it in your wallet, you can move it around, have all the benefits of crypto. But unlike crypto that is volatile and moves around, it's supposed to be backed one-to-one by the US dollar. So you do have two types of stable coins. One is an algorithmic type of stable coin, which that's what Terra was. So it's backed by some kind of system, whatever that system is. And then you have stable coins that are actually backed by true US dollars. Like USDC is a really good example of that, where there is, or I hope there is, real US dollars in an escrow account that support that currency peg. It was actually interesting during the depegging event, USDC traded higher than par value because a lot of flow from US Terra went there following that depeg. So it did help stability. And
we can cover all that at the end, but I think for now, tell us a little bit more about what happened.
Yeah, so absolutely. Luna is basically the equity capital for Terra. There's this create destroy relationship between the two that's supposed to keep the peg stable. So if there's too much demand for, let's say, Terra, there is this arbitrage opportunity with Luna to either destroy it or create it in order to keep that peg the same. And then basically you need to have the way Terra is backed, it's really backed by a lot of Luna. So if there's a lot of Luna behind Terra, then the peg is supposed to be stable. But what happened, and we'll go to that in a second, is that the ratio of Luna to Terra diminished over time as the peg became unstable, not too dissimilar from what happened with the British pound. Now, what's interesting too is that they said that this platform is decentralized, but it's really not. It never really was. You see that in their programmable money for the internet. They're saying Terra is this algorithmic decentralized stablecoin. Not true at all, which brings DeFi to the masses. And let's dig into Terra a little bit to understand this better. So it's a proof of stake smart contract crypto, fully algorithmic, which again is not backed by true US dollars. It's backed by something else, and we'll talk about that something else. There's been a lot of attempts throughout history to create something out of nothing. Most of them have not worked too well, because at the end of the day, when you don't have a true stable system to back something, there's no real innovation in the space. It's really difficult to create yield out of something that doesn't really exist. So the idea behind Luna is really the stabilizer of the entire Terra ecosystem. It's this volatility offset. So the idea here is that if there's a lot of demand for Terra and then it goes over $1, you can have an arbitrage by burning Luna that you own in order to create more Terra. So if you create more Terra from Luna, then the peg goes back to 1, and then you make that arbitrage between what those prices were. So it's the market is incentivizing you to do this. And if US Terra goes below 1, so let's say a lot of people sell US Terra, you can create Luna, yield farming and all those type of opportunities, and burn Terra, and then that keeps it around 1. It's really like you're incentivizing the market participants to be the market maker for Terra on both sides by making this arbitrage consistently. And that worked for a while, as long as there was yield, as long as there was enough liquidity in both Terra and Luna.
Okay.
So the problem is, if Luna doesn't keep pace with Terra's market cap, over time, Terra becomes less backed by Luna. It's not very dissimilar from money moving away from the UK because for greener pastures in Germany. And it becomes less, basically, you can think of it almost like the central bank running out of reserves over time and backing their currency with less and less reserves.
So does that mean that as more money moves into Terra in this case, and the market cap becomes bigger and bigger, if there's very low Luna, that's the equivalent of your FX reserves?
That is exactly what I'm saying. You're
okay. So that means you could burn out all the Luna, and then there's nothing left.
So you can see this explosion in Terra's market cap that happened 2021. I believe it got to over $40 billion, if I'm not mistaken. And Terra became the second largest ecosystem in DeFi, second to Ethereum. And you could have seen here that we did have initial almost depeg event that took place in 2021. And then as time progressed, the ratio of Luna to Terra continued to diminish to much lower levels, and made that actually less back. So it's exactly like it. And why did you have all this demand for Terra that wasn't necessarily backed by Luna? It's because of the Anchor protocol, right? So they were basically giving you a risk-free 20% return for just sitting and holding US Terra. So it's not really backed by too many things. I think that because at the end of the day, this entire protocol was backed by VC dollars, in a way, it was almost like those VC dollars were giving you that 20% on US Terra. So it's really not backed on a sustainable mechanism that is repeatable and scalable and can last to infinity. And that was really the problem behind it. And then you get into the death spiral, right? So what is that death spiral? Is that if the capital dries up over time, then the demand for UST will decline. They really didn't want to lower the yield because they were worried that that will send Terra into this death spiral. So if Terra demand shrinks, you can get this negative feedback loop for liquidity, which eventually could depeg the entire system. Because if the price of Luna just crashes completely, then there's really not enough Luna to back Terra, and then the peg itself goes away. So you saw there was a ratio of 200%, and then it falls to like 50%. It's the equivalent of the central bank just running out of FX reserves and not being able to back their currency anymore. Very similar to a currency crisis. I believe you are on mute.
One thing I don't understand is if UST is being propped up because of the interest rate that it has, what if they would have cooled down the interest that they were giving to go 15% versus 20%? Were they really at risk of this debt spiral?
That's such a great question. And I actually know of a very large fund that had some big issues with this ecosystem. And they were actually talking to them, asking them to lower the yields because they were actually worried about this. They were actively asking them to lower the yields. They didn't do it because they were worried that it will cool off demand. But eventually, I think they would have, this would have still happened. But if they lowered the yields to, let's say, 12%, it probably would have delayed it because it would have been more sustainable over time. So you're actually right about that instinct.
Okay.
So back to that, we have to realize that unlike Bitcoin, that is truly decentralized, nobody really owns Bitcoin. Nobody's going to back Bitcoin. Nobody's going to have reserves for Bitcoin. Most of the networks are completely centralized, right? So Terra had the Terraform Lab, Solana is a Solana Foundation. And usually, you know, it's for profit. Like they're propping up their own type of crypto. They're trying to make money off of it. They basically use it for those purposes. And what they were doing is they were actually raising capital to create a defensible layer for that peg. So they're literally collecting money. They're trying to buy Bitcoin to act as reserves. They were really acting like a central bank trying to defend their currency peg. Like they were basically trying to buy it. They're trying to defend it. They're trying to stabilize it. And of course, you know, we all know how that ended. And that was the quote that they put on. I don't need to necessarily read this, but they were saying that they're really going to defend the peg. They're going to take whatever measures they can. If it's close, they're going to be able to arbitrage it. They're going to have more reserves to capitalize it, et cetera, et cetera.
Why? What I don't understand is why would they want to even hold BTC in reserves? What is the point of having a whole bunch of these other cryptos in reserve, especially if those are volatile?
I think that BTC is seen as this ultimate store of value that is really decentralized in the crypto world, right? Because a lot of these holders of Terra are crypto natives, and they view BTC this way. So I think it's kind of this idea that, you know, the dollar is the enemy, so we're going to use BTC.
I understand. Okay.
But again, I'm speculating. You know, and this is exactly why you study history, because this sort of thing has happened in the past many times, and almost every time ended in this kind of way in the currency playbook. So what they're doing is, you know, in the good times, let's say an emerging market, they accumulate the trade surplus, currency sales, and they increase FX reserves, they increase dollars reserves, they increase gold reserves, etc. And then if there's a problem later, there's a recession, there's external flows that come out, they use those FX reserves to defend a currency peg and to strengthen out their currency. Typically doesn't play out that well, but that's been the case many, many, many times in many, many different places.
Well, what about China, who seemed to have done a very good job using a currency peg, and frankly, has probably taken them, lifted 1 billion people out of poverty.
That's always the exception to that rule. So China is China. China has an insanely large economy, and what is it, 1/5 or 1/6 of the global population.
Yeah,
they have the ability to go on much longer than anybody else. They also have a non-democratic government that can make very strict decisions. So, I think it also has to do with their relative size and power and economic might.
got it. So this is your currency playbook, unless you've got 1 billion very competent people and a strong authoritarian governments making decisions.
Jim Chanos, he's a very famous short seller that ran this fund, and he looked at Chinese stocks as like, well, I should short this, and he realized he can't short anything in China because he said, China is like a pig on LSD. You never know what direction it's going to go.
That's quite the quote right there. I'm trying to envision this going on in my head. Here in Texas, you got enough of these wild pigs. I could only imagine what seeing that would look like.
Right, exactly. So Anchor eventually got to the point where the reserves started dropping because of, again, the artificial high yield started decreasing, and that because too many people were just making too high of a yield that was just draining the reserves entirely. It was not a sustainable system. And eventually the founders realized that they either need to inject more money into it to keep that yield. So if you think about it, it's funny. It's almost like the VCs that invested in it are the ones funding your 20% yield. It's, I think, not the best use.
So let me make sure I understand this. So this money that somebody's investing in, that's just on the sideline there to maintain the peg and pay your 20% interest rate, right?
Right.
So then all this capital flows in, it's just paying. And then what's the breaking point? Like what happens that starts triggering this downfall?
You just run out of reserves. So what they have to do, the choice they have to do, they have to either replenish the reserves, or they just need to depeg, like what the UK did, which they probably wish they did that earlier, because there is a crypto market rate for this yield. I think it's probably 8% now or 6% now. So if they did that, demand for UST would fall substantially, but then their system probably would have been stabilized to a degree.
So it was a Ponzi scheme the entire time, where it's basically, let me just take one person's money to try to pay the next guy.
That's pretty harsh, but it's not necessarily wrong.
Okay, I understand.
So now you're seeing the collateral dropping in value quite a bit over the, even in April. Which you can see that, and that contribute to this massive destabilization of Terra Luna, which we all know how ended in both US Terra market cap as well as Luna. Not fun for the investors in those protocols.
Got it. And is it still trading basically at the same levels, more or less?
I think it's gone.
It's done.
It's gone. Yeah. And if you really think about it, the reason it broke at the end was, yes, due to a speculative attack. There is evidence that there was a well-funded attack with timing when it was weak, when it was depegging, and it was a coordinated, almost Soros-style attack, just like what he did with the British pound, basically selling short and pushing it for depegging, draining it from liquidity, and eventually profiting from this. Not very dissimilar from what happened with the British pound in 1992.
So theoretically, if you're one of these central banks concerned that cryptos might take over they might take over your world, couldn't you just basically launch this type of attack across the board on different type of currencies until you wipe them out?
I mean, it depends on the currency. Only if they have weakness in them that allows it. I mean, there was, a few people described how the protocol could be attacked in 2021, and this attack actually really followed that playbook. It was really similar to how that unfolded. And you know, at the end of the day, to that point, I don't think you can blame the player, right? You can blame the game. So it's a recurring theme in markets.
So don't hate the player, hate the game.
That's right, because if something can be attacked in markets, you should assume that it will be attacked. It's not the fault of the speculators. It's the fault of the algorithmic stablecoin that was just inherently an unstable system. And at some point, it was just due to break. Whether it's now or in a different time, it was just not properly and efficiently created. And it goes back to this idea that many, many times people have tried to create something out of nothing and it never worked out, because you need to create some level of value. There needs to be some kind of exchange of services. There needs to be some kind of creation in order to support price increases, in order to support an inherent system. And I just don't think that it existed in that ecosystem. And when you study history, you see these things repeat themselves over and over again.
That was great. Thank you.
So lastly, I would just mention that it's during the bear markets that you really see what's real and what's not. This example is in crypto. I found that to be interesting there, that you have all these crypto Ponzi schemes during periods where markets are booming and ISM, Purchasing Managers Index, PMI, is increasing. And then a lot of these schemes just break down during bad economic times, because when liquidity is poor, money is just looking for the best assets. That's when things break down. It's not a coincidence that during the 2000 to 2002 bear market, we've had Enron and WorldCom blow up because there was a lack of liquidity and they were just not properly built. In 2008, 2009, we saw Bear Stearns and we saw Lehman Brothers, right? But we also saw Bernie Madoff. Why was Bernie Madoff discovered in 2008? Because only then there were redemptions, and then they realized that he was using the first investor to pay the second investor, and only then that Ponzi scheme really came about. So it's during the bear markets that you see what's real and what's not. And if this is really one of those times where we do see a lack of liquidity, which seems to be the case thus far, that's the time when you really see what's for real and what's not.